Yeah, that's me talking about tokenomics today. Just a few things, as I said, please put yourselves on mute. Otherwise, you can use the chat, but I might only come to questions at the end, only because my sharing screen situation is not great at the moment. If you want to turn your mic on and maybe interrupt me, I absolutely don't mind at all. And I've kind of used some things that I think the person who'd done the team before this had kind of picked up on. So it's basically the same setup if you guys were watching the previous talks. Brief introduction about myself, an overview, and then we'll go into, I just went question for question, kind of answered them. But I thought it was good to like get an overview at the beginning. Mayank spoke a lot about what I'd done before. I think it's generally that I came from a traditional finance background, big interest in what blockchain can do for financial services. There's a lot of scope for kind of improvement in financial services, and this kind of innovative technology will make a huge difference in my mind. Currently the head of research at Cyber Capital, and we have some affiliates here today. And I think I left the last bullet at the bottom because I think that in this space, it's very new, very nascent, and there's a lot going on. So it's quite a journey, which I think is important. So when I think about tokenomics, and if you take a step back from, the direct questions that are in the report, I like to think about them as kind of dynamic digital assets. And by that, I mean, especially for the purposes of the protocols that I think that prime research has been rating or intends to rate in the future, like to simplify it at a very high level for most people to understand, we can see it as somewhere where it's a quasi cash meets equity. And if we look at, portfolio or economic theories that play into the value of these two assets, we can paint a better picture of how we view this new asset. So in terms of cash, we know the things that affect, the value and the volume of cash are things like interest rates and inflation. And in a security like an equity, we know that they come in different forms. So you can get like a ordinary share or a preference share or a share that has voting rights or a share that doesn't have voting rights. And those are the kind of dynamics or characteristics around these kind of securities that I think we can, use to guide a framework of how we may view tokens and the use cases that tokens are being used for right now. As I said, they can have many different purposes because they traditionally can be, we can use coding and programming to kind of, code certain characteristics into different tokens, their attributes and their characteristics. They come in different forms. And I think one of the more interesting things that we are yet to see, and by virtue of you all sitting in this room today, I think something that's quite fascinating is, in future we'll be using something like NFTs as entry tickets. If you want to go to your favorite concert for a musician, or you want to go to a football match or rugby game or something like that, that's a kind of use take off. And that's, I suppose, when we're dealing with this report, I suppose it's more fungible tokens that are listed on exchanges, but this concept of a token and its value, it's very open-ended. There's a lot to it, more than just kind of a medium of exchange. And these last few are just general things that I think paints with a very broad brush around how we can understand the value drivers that exist. So if there's a high concentration for things like, if it's a governance, then, governance is concentrated to one party or to a select handful of parties. If it has to do with kind of, threat of, let's just say, dumping, then the threat of dumping from one or a handful of parties is obviously greater with greater concentration. High inflation in any kind of asset will naturally decrease its value. I think that's something that we use case for tokens is obviously something that is that we want to see persist. Well, not everyone. I mean, we come from a background of fundamental analysis and taking a long-term view of what a token is and how it can be used. And in that kind of space, then the use case is traditionally quite important. I think if you're doing, opposed to if you're doing like technical analysis and your investment strategies based on technical indicators, maybe the use case. In order to be able to exchange and be able to evaluate something's value, could be worded better, it would obviously need to be liquid and easily transferable. And there we're talking about, where can you buy and sell this token? Is it available in the kind of quantity that you would expect to be reasonable in order to realize value in this token? And then it may or may not include value accruing mechanisms. So things like burning is a very easy thing to understand. It's kind of has deflationary pressure on the volume or the supply of the token. Sorry, I'm kind of just going to. Oh, Azeb, I can change it to full screen. Okay, so I'll just encourage you guys to shout if, the reason that I didn't want to change the full screen is because I'm going to be clicking on the links. So just to show people, I think it's easier that way. Is a token sufficiently distributed? Okay, this is obviously talking about chart comes up a lot, and this is for initial allocations for public blockchains, and we can see that things like Ethereum are obviously a lot less concentrated than something like Binance or Tron or Polkadot. And what we're looking for this specifically is like how in these we can see that there's a lot that goes to inside VCs. Now, like having a high concentration of tokens towards a handful of participants that are insiders or may have more knowledge than the public is obviously dangerous. If there is adverse information available, they're typically the first to know. And in an unregulated space, unlike traditional financial markets, you tend to have people who will have have nefarious actions and may dump tokens, which will have adverse effects on general investors or people that may read this report and want to know what is the risk of dumping on me as a token holder that may not have huge bags or a lot of money. I just wanted to show you another example of distribution here with the Matic token holders, and using something like Etherscan is a really good, or Block Explorer is a really good way to show concentration. So here we can see the distribution of the top holders of the Matic token, and a lot of these Etherscan shows that these are in contracts, the vesting contract, the plasma bridge, and then other holders who are typically, I suppose, would be wallets. So this is obviously just a good way. I just want to show you guys, use block explorers and think about using something like Etherscan, or I'll show you Solana bridge in a second too, which I think is quite interesting. So the extent of the token's capabilities, this is typically how it is used within the protocol. So, things like medium of exchange, I mean, that's generally, is it versatile as a medium of exchange? But I think what's more relevant here is things like staking and governance. So in a proof of stake network, you'd obviously have to stake a certain amount of tokens to become a validator, and that's a direct use case within that network. Governance typically have to stake in order to, not necessarily become a validator, but stake them in order to gain governance rights, and that will give the holders the ability to vote on specific proposals. Other use cases that exist, so it could be reward incentive, providing like if you're providing liquidity to a platform, then liquidity miners could be, or liquidity mining programs could be incentivized by providing rewards. Polkadot, for those of you that are not aware, is another layer 1 network, and it has parachains that are involved in an auction. And in the auction, you have to bond what they call bonding dot in order to win a space on the relay chain for your parachain to be connected. So that's another use case. And I think that what's important to remember in this environment, and as I mentioned earlier, is that the use cases that we are seeing now are certain ones, and I think there might be others in future as people are able to kind of, it's a very dynamic process, and there might be other use cases in future that may come to light. I've left a little link there for the different types of ERC. Actually, most are ERC20s, which I'm sure you guys are aware of, but there are other versions like the NFT for thing is 721, and just other token specifications, which I think as the industry develops, we'll see various types of tokens exist. So to what degree is the distribution model able to improve the coordination of the protocol? I chose Curve and his example here to use because I thought it was quite interesting. And I kind of want to take you specifically to this report to kind of just go through a certain section. So it's here around the distribution. It tells us that they started with an initial supply of 1.3 billion. And this is allocated to those four groups here with a certain vesting period. And then it tells us that the remaining 57% of the total maximum supply, which I think is 3 billion, if I'm not mistaken, is released to future liquidity providers. Now, Curve, if those who are not aware, is a decentralized exchange. It specializes in stable coins through a certain advanced mathematical formula, which is specialized for stable coins for the purpose of this discussion. So the fact that 57% of the total supply is going towards people that to provide liquidity is I think that is like a direct use case of, you know, they're using the token to promote the use of their protocol directly as a decentralized exchange. People are coming to them, provide liquidity in their automated market maker, and by providing liquidity, they're being rewarded in Curve tokens. So in a case that shows that they're using the tokens directly towards sustainability of the platform. Now, this is yet to be determined. We can see that this is a 5-year or 5-year vesting schedule. Now, when these liquidity rewards run out, you never know what can happen to the volumes on, or the TVL within the protocol. It may remain or it may fall away because the incentives are not there anymore. And these are the kind of things that I think we're yet to determine in such a new industry that is obviously at an early stage. The value capture model to accrue and distribute value. I liked the example that I like to choose here was index, and I might in reference index again. This is a report that Mike and I had done, so that's why it's a bit close to home and one that I know relatively well. And I really like that the way, I mean, again, this is something that somebody within their team had chosen to kind of show how value will be accrued. I think it's these things are they clever suggestions, but we are yet to determine if they're going to be successful over time. But it's a very clever way to kind of analyze whether they're able to create something that can accrue value. So you can see this flywheel generally how it works in the treasury, and there's the index token itself is used as a governance token. But if we go down here, in order to increase assets under their index group itself is a DAO that has various indices. The flagship index is the DeFi Pulse token, which is basically a basket of DeFi protocols, and the index itself is a DAO that kind of manages various indices. So to increase their assets under vault, they're incentivizing here the methodologists who's bringing in better products, and which accrues to index token holders. So that's a certain top right part of their flywheel. Then in order to widen the distribution of index tokens itself, incentives, which is this turquoise part at the bottom. And in order to engage and align voters, the governance is protocol positive decisions, and contributes towards, governance that's where the community is aligned with the DAO and basically all stakeholders within the system. So this is just one system which I thought was quite an interesting way to understand how this index governance token can create and accrue value. Again, I do think that these things are, they're systems that are yet to be tested, but it's a clever way to understand and kind of describe how a report like this. The next one is, just very simply put, around liquidity. And I chose on the left is kind of these statistics quite easily, and I think it's generally a relatively easy question to answer. On the left, I chose Ethereum, which we know is obviously traded in very high volumes all the time. On the right, I chose something as random as possible. I don't know how I got there, but it's some token called bird money. And on the left, you can see high volumes being traded on various exchanges. Both, Ethereum is changed. Those are only centralized exchanges, but it's obviously traded on decentralized exchanges too. On the right, interestingly, which I want to point out, is that although this is traded across centralized and decentralized exchanges, if we look carefully at the volume, it's exceptionally low. And so these are things that you can easily spot and make I suppose, easy comparison when writing these reports and answering this question. So extrinsic productivity use cases. So beyond the protocol in which the token is kind of developed and used, what else can you do? Can you take this token and use it anywhere else? Does the token have composability to be able to use in other protocols? And I just want to compare two tokens again. I've already introduced you guys to this, but Ethereum is typically it's direct use cases being able to to pay for gas, to execute smart contracts. But we also know that you can take Ethereum and use it as collateral in a whole lot of different projects, which is obviously very useful. And I'm sure it's got, we can go and list, there's endless kind of external use cases for very big, I suppose Ethereum in general. Now, the contrast that I want to give here was this DeFi Pulse index. So the DPI is the name of the token. They are managed, I suppose, to put it very loosely, by that index coup, the token that I introduced earlier. So this is a decentralized index which tracks the performance of DeFi projects. Typically, people that would buy this, the immediate, kind of answer, and I think for a vast majority of them, is for the capital appreciation for, a basket of goods of blue chip verified DeFi projects, and looking at the capital appreciation. However, as written by them, and I suppose this is quite an interesting contrast because I don't think that we had got it perfectly right, Mayank. And I was in my section. So this is written by someone within the index group, and it's what can you do with your DPI? And in this, I'll just, for the sake of time, scroll down. And in this, you can provide liquidity. So if you want, in some pools, I think it was Balancer specifically, if you add DPI and ETH, you're providing liquidity, and you can get rewards for providing liquidity. Yield farming, borrowing and lending, and uses collateral debt position. Now, what I did was I also looked into each of these and saw whether this is actually the case, because this is coming from the index itself. So here, there's talking more about providing liquidity, borrowing and lending on Cream and Alpha Homora. And here, you can provide as collateral debt position. Now, when I Googled that, I found that Aave is set to disable borrowing on XSushi and DPI, citing potential exploit. So this is just an example of kind of, doing research beyond what's kind of right in front of you, or what's just told to you by people within the ecosystem or within the protocols who might be doing, some sense of marketing, and really understand what the current situation of or evaluation of the evaluation of the situation is, should I say. So as it says here in this Yahoo Finance article, that they had to pull DPI from being used as collateral in a debt position. And yes, please don't hate me, guys, but I did use the example that Mayank and I had done as a kind of best practice. I thought it was pretty well done, and Zeb also reviewed this, so you can be sure that it's good. I just want to take you through briefly some of the charts and things that we had used, because I thought it was quite interesting to see, to give you a good example, I suppose, while we're here. So active indexes, sources Glassnode. It's a very clear indication of, how many active addresses are using the index token itself. Here you can see the distribution. This is taken from CoinGecko. Again, further more about how concentrated the holdings are, and more about the distribution, the lockup, and if there's any vesting. What can you do with it? Here's a release schedule. And this comes down to in the index token, it was quite interesting because they're accruing streaming fees. The streaming fees are going to Treasury, not necessarily to the index coup token holders. When there's a lot of protocols that do have their own governance token and are accruing revenues and accruing fees. A very good place to look for how many revenues are being generated is Token Terminal. Big fan of them. And you can see how much fees are accruing from things like trading or streaming fees in this case. And then to determine whether or not, they will ever distribute to token holders, they intend to, or they don't intend to, or they are already. I think something like Curve is distributing to its token holders, but something like Yearn is not. And they're both generating a lot of money. And that you can inquire and ask and talk to the people within the Discord, the Telegram groups, and kind of get a sense of, what's the kind of reasonable prospects of whether they would or wouldn't distribute kind of streaming fees or trading fees to token holders. More in liquidity, and then there was something in external use cases, but this was with DPI. So I just spoke here that the index token itself is only used for governance and meta governance of the tokens within its basket. And as a side, we talked about how DPI can be used in other applications. So in this case, we actually gave it 0. This is taken from the person who was before me, but I just wanted to build on, some of the things when writing these reports for Prime. Mayank and I had adopted a consistency to always have like 1 to 2 sentences at the end of each subsection as to why that specific score was given. And the more you see and the more research you do, the more you'll be able to give scores on a relative basis, because there's no absolute way here. I think that a lot of these things are relative, just because of the structure and the nascency of the industry. Be critical. Use a variety of sources, like I showed you just now, around how don't just use stuff directly from the protocol, or don't just use Glassnode or Mozari or Nansen. Kind of aggregate sources of data in order to make it a more comprehensive report that is useful for the reader. Yeah, these are honestly just a handful, so I would look more deeply. And I think that I'm assuming that there'll be some kind of source list through these expert talks that will unfold, but I just showed a handful here. And if we have time, I'll go to the Solana beach, but it's not necessarily necessary right now. Yeah, I just because we're on tokenomics, I thought it was an interesting thing to talk about is type of token launches, and the biggest two, I suppose, contentious things are pre-mine versus fair launch. And in a pre-mine is as it sounds, it's like a certain amount of the tokens will necessarily go towards particular addresses, and then the source code is open to the public and kind of so a certain amount is already held by insiders before the application is launched or the source code goes public. So obviously something like Bitcoin didn't engage in a pre-mine, and it was the Genesis block, and it grows from there. And the block rewards were very high, and over time they decreased in order to I think that's people are aware of how the Bitcoin structure is. And then opposed to a pre-mine is the concept of fair launch, where it's obviously equally available to all participants or stakeholders in the industry at the same time. One of the interesting things it's the incentive structure for the team. So a team, that last bullet says, a team that gets rich overnight before any real work has begun will give up. And I think that's quite true. When how people are incentivized is very important in this industry, and people can come into a lot of money very quickly. And they could hold a lot of power and sway in certain protocols, and then their kind of incentives as to why they're doing what they're doing can be swayed or can be skewed. So this is like it's the perfect economics of how finance meeting people and how they deal with these things is hugely important, and whether they actually want to continue doing what they're doing for the greater good of the industry, or they're doing for other motives. This will take it from someone else, but it is examples of reports that I'd won previously. And that is it for me. So I know it was relatively short, but I'm happy to take questions. I can stop presenting, or if anybody wants to jump in, feel free.
Santos, there's a question in the chat. Can you read it, or I can read it out for you?
What Zeb asked, what does the perfect tokenomics look like to me? I don't know if I'll be able to answer that perfectly, but I think it's a good distribution between incentivizing insiders, developers, and people that can create a sustainable protocol. Enough token sale towards the public. So that I would say that would, in that weighting, there will be a small distribution or proportion towards insiders and people that are developing for sustainable growth of the protocol, and a pretty large distribution that goes towards the public in order to incentivize trading or incentivize kind of market making to gain a fair price. And I also think that there should be some kind of vesting schedule attached to the protocol develops. So everything can't just go towards insiders, or I'm going to use the word management, but I don't know if that's completely perfect. Yeah, a huge amount can't just go to insiders immediately. I think it has to be earned over time, and freely without encumbrances or being locked up. That kind of, I think that the markets are able to decide token prices. That's how we should view it, in a kind of free market space. I'm not going to give numbers. Okay. Reading out XMVN, wondering, isn't the distribution of token context dependent? Isn't the goal rather to hand out to token to relevant stakeholders, although it might lead to higher concentration? Would you, and if yes, how would you consider this? I don't know if I fully understand the question, so I'm willing, if you want to Champagne.
Sure, happy to elaborate. No, what I was wondering about, and sorry, like it was a little butchered in English, so I can understand why it may be hard to understand. But I was wondering, in the sense of, if we look at the token distribution, doesn't it matter as well what the protocol is doing? I'm not sure how applicable this question is anymore after the last question you answered, but I'm always thinking, isn't it rather handing out the tokens to the relevant stakeholders, even though that might lead to some sort of centralized or more centralized distribution relative to other protocols? So I don't know if like
sorry,
what. No, go ahead. Like, I'm not sure if I made myself clear or understandable.
No, I think you have, and I can use two examples which I think are quite relevant. So if let's just say, like, I want to compare, and again, I'm going to talk in a very general sense, and because I think that's more helpful than my hypothetical, let's say. But if we look at let's compare Ethereum and Curve, for instance, right? So Curve, as I said, is a decentralized exchange. It wants to attract. Think that Ether can only be used for gas. It's got an open-ended supply, and it's got a burn feature, and it is just being used for gas continuously. So it's public, like the amount that's allocated to the public is an enormous amount. Whereas so that kind of token distribution, if I want to go back to, let me just go back to the chart so that's easier to see. You can see Ethereum here. I know this is tiny, you guys. I'm going to do this then. A very large proportion went to their public sale, right? Whereas if we compare something
Santos,
like that
sorry,
to Curve,
sorry, Santos, you need to share. It's not shared anymore.
Oh, sorry.
Your screen is not being shared.
Yeah.
No worries.
Yes. No. You guys can see it now, right? And if we look at the Ethereum, the amount that's allocated to the public is almost 80%. Whereas if we compare it to something like when I was showing you guys Curve earlier, and here it says that the remaining 50% of the total maximum supply to be released progressively as incentives to future liquidity providers, that shows that they are kind of they're people to do in the ecosystem. And those are different things, those are different approaches, but I think that they're both trying to achieve what they want to. So yes, I do think that to some degree, different protocols could be applying different distribution structures, let's say.